Imagine you are coming home after a tiring day at work. You open the door and a horrifying sight meets your eyes. Your money is playing video games on the sofa. Next to it are snacks and a pile of dirty clothes. You are so angry that you yell at it. Get a job or do something useful, you useless idiot. As usual, the money replies, but how? I'm just money. You basically cannot get me to work. But today, you have another plan. Nah, I'll invest. So, what the heck is investing? Investing is an act of committing resource, including money, time, efforts, to field asset or project with expectation of obtaining future benefits. There are 5 popular forms of investment. First, financial investments, including buying stocks, bonds, investment funds, cryptocurrencies, forex, etc. Real estate investment, buy land, houses, apartments, offices to rent or wait for price to increase. Business investment, invest in startups, open companies or buy businesses. Invest in yourself, study, improve skills, take care of your health to increase personal value. Yes, yourself, guys. And lastly, invest in commodities such as gold, silver, oil, agriculture products, and we often have following investment goals such as protect assets against inflation, generate passive income, or build a lasting career or fortune. But it also comes with the following risks such as market volatility or asset prices fall, inflation or economic crisis, lack of knowledge leads to losers. Generally speaking, stupidity leads to death. However, the benefits are quite a lot, such as financial profits, added value, knowledge, health, and reputation. In this video, I will only talk about 2 popular types of investments, including stocks and bonds. The stock, also called a share or equity, represents a unit of ownership in a company. When you buy stocks, you become a shareholder, which means you own a small part of the business and can benefit from the business growth and profits. In exchange, companies issue stocks to raise capital via IPOs or secondary offerings. To make profits, you can either buy or sell the stock in the stock market or receive the dividends from the company after a period of time. Shares may exist until the company is dissolved. We have 2 types of stocks. The first type is common stocks. You will have the voting rights at the general meeting of the shareholders. Receive dividends if the company makes a profit, or may have the priority after bondholders and preferred shareholders if the company goes bankrupt. The second type is preferred stocks. You will have no voting rights usually, receive fixed dividends before common shareholders, and preferred payments when the company is dissolved. Preferred stocks comes in many varieties and is often restricted by its transfer by the company's charter. Meanwhile, common stock is usually the majority and is freely tradable. How does a company issue shares and bonds? First, the IPO, initial public offering. The company offers shares to the market to raise capital. After IPO, they will private replacement, reselling shares to institutional investors, or ESOP issuance for company employees only. How stock prices are formed? We have the basic formula. You have to subtract the company value by depths. After that, divide the answer with the total number of shares. The result is the stock price. But we also have factors affecting prices too, such as business performance, like EPS or profits, macro policies such as interest rates, taxes, and the market psychology like fear of missing out or sell-off. There are risks you must know to avoid, such as strong prices fluctuation, because stock can drop like 50% in just a few days. Liquidity risk. Stocks with low trading volume are difficult to sell when needed. Loss of capital if the company goes bankrupt, because common shareholders are the last to receive money when assets are liquidated. Again, generally speaking, stupidity leads to debt. A bond is a debt instrument issued by a government, business, or organization to raise capital. For those of you who are still wondering, unlike stock equity, bonds represent a creditor-debtor relationship. Some core features of bonds are pays periodic interest, coupon, and repays principal at maturity. Convertible corporate bonds, which means you can convert bonds into stocks, just like Transformer. Zero coupon bonds do not pay periodic interest, only pay principal with interest at maturity. Bond is a debt asset with a term from 3 to 30 years. Though we still have three types of bonds. First one, government bonds issued by the Ministry of Finance and State Bank. The risk and profits are usually low, with a term from 1 to 30 years. For corporate bonds issued by joint stock company group, the risk and profits are always higher than the government bonds, with a term from 1 to 10 years. International bonds issued by the government enterprises issued abroad. The risk is the exchange rate and the political risk, with the profit will fluctuating with the international markets. The term will be 5 to 30 years. How bonds generate profits? Coupon interest paid periodically, monthly, quarterly, yearly. Price difference. You can buy low and sell high in the secondary market. It's basically the same with the stock market. We still have several factors that affect bonds price, such as credit rating. If the company downgraded, the risk of default increases, thereby bond prices will decrease. Inflation. If inflation increases, the real value of bond decreases. Bank interest rates. If the bank interest rates increase, the current bond price is decreased because the investor will switch to a higher interest channel. This credit risk default. The issuing enterprise or organization cannot repay the debt, but it occurs rarely. Liquidity risk. Small corporate bonds are difficult to sell before maturity. Interest rate risk. If the market interest rates increase, the current bond price decrease. Now, if you have a blue bar representing stocks in your right hand and a red bar representing bonds in your left hand, you have the perfect combo to diversify your portfolio and reduce risk. So, thank you for watching my video. I know this is my first time making a video, so there will be many mistakes. So I hope you can give me the feedback and share your opinions in the comments.